Stop scrolling. If you own gold or silver right now, or you've been thinking about it to protect your savings, this has been a brutal week. Gold just dropped about 5%. Silver got cut by nearly 10% in a few days. And every headline is asking the same question. Has the shimmer finally worn off the metals? CNBC ran exactly that line this week. Here's what I need you to hear. The people writing those headlines are looking at the wrong thing. Because while retail investors were panic selling this dip, one buyer quietly bought 244 tons of gold last quarter, and they're not slowing down. By the end of this video, you'll understand exactly who that buyer is, what they see coming that most people don't, and what this pullback actually means for your money. And that buyer? It's not a hedge fund. It's not Warren Buffett. It's something far bigger. And once you see what they're doing, you can't unsee it. And real quick, before the comments fill up with, gold always goes down when the Fed talks. Yes, it does. But this time the reason it dropped is the exact reason it matters more, not less. Stay with me for 90 seconds, and I'll show you why the cause of this crash is the most bullish thing in the whole story. This took me a while to connect. It's worth it. And because I know the real question you're asking is what does this mean for my savings? I built a free inflation protection checklist for exactly that. It's at timtalksfinance.com. I'll point you to it again at the end, but if you can't wait, it's there now. Let's start with what you're actually feeling, because it's real. If you bought gold or silver this year, you watched something incredible and then something painful. Silver went on a 150% run in 2025. It blew past gold. In January, it touched an all-time high, around $116 an ounce. Gold cracked $5,000 for the first time in history. And then, the air came out. Today, gold's back around 4,000. Silver's back near 59. Silver is down roughly 46% from that January high. Now, if you're sitting there thinking, great, I bought the top, I'm the sucker, I want you to take a breath. Because that feeling, that exact feeling, is the one the headlines are feeding on. Look at what's getting the views right now. One of the biggest precious metals channels just posted a video literally titled, Silver Price Crashing. Is this the bottom? It has over 180,000 views. The whole market is staring at the floor, terrified, asking the same question. And here's the thing nobody's stopping to ask. Why did it drop? Because the answer isn't gold is dying. The answer is one specific decision made by one specific institution 8 days ago. And once you understand the mechanism behind this drop, you'll see why the people selling right now may be making the most expensive mistake of the cycle. So, let's break down what actually happened. Calmly, step by step. Gold and silver didn't fall because of supply. They didn't fall because demand vanished. They fell because of the Federal Reserve. 8 days ago, the Fed met, and instead of cutting rates like the market hoped, they did the opposite. They turned hawkish. They put rate hikes back on the table. Markets are now pricing in an 80% chance of a rate hike in December. Read that again. Not a cut, a hike. Now here's the mechanism, and this is the part the headlines skip. Gold and silver don't pay you interest. They just sit there, holding value. So when the Fed signals higher rates, two things happen automatically. The dollar gets stronger, and bonds suddenly pay more. On paper, that makes a metal that pays you nothing look less attractive for a minute. Money rotates out of the paper gold market. The price drops. But notice what I just said, paper gold. Because there are two completely different things, both called gold in this market, and confusing them is how regular people get shaken out. There's the paper market, futures contracts, traded by hedge funds reacting to every word the Fed says. That's what crashed this week. And then there's the physical market, actual metal, bought by people and institutions who are holding it for years, not minutes. And those two markets are telling completely opposite stories right now. We're about halfway through. The first half was what happened. This next part is what it means. And it's where the open loop from the start pays off. Because while the paper market was panicking this week, the physical buyers did something the headlines completely ignored. Here it is. Central banks, the national banks of countries around the world, bought an estimated 244 tons of gold in the first quarter of this year. That's above the previous quarter, above the 5 year average. And in a survey, 95% of central banks said they expect to keep adding gold this year. 95%. So sit with that contrast for a second. Retail investors this week, selling, scared, asking if it's the bottom. The most sophisticated financial institutions on earth, buying at a record pace into the exact same dip. Now you might be thinking, okay, Tim, the central banks are hedging the dollar, but how do I know if my savings are actually protected? That's the right question. So I built a simple checklist at timtalksfinance.com that walks you through exactly where inflation is quietly hitting your money: cash, bonds, savings, and what a hedge actually looks like for a regular saver. Takes about 2 minutes. Links in the description. So the question becomes obvious. What do the central banks see that the headlines don't? Because that's where the money actually goes. Here's what the central banks are looking at. And it's the same thing I've been walking you through on this channel for months. The US government is carrying around $39 trillion in debt. Inflation, by the government's own numbers, just accelerated to its highest level in years. And the Fed is trapped. It can't raise rates hard enough to kill inflation without blowing a hole in a government that can't afford the interest. When you're a central bank, and you're holding billions in US dollars and US bonds, and you watch inflation eat the value of those bonds while the government keeps printing, you start looking for something that can't be printed. Something with no counterparty. Something that's been money for 5,000 years. That's gold. They're not buying gold as a trade, they're buying it as insurance against the dollar itself. And silver rides the same logic, except silver has a second engine the headlines forget. Roughly 60% of silver demand isn't investment at all. It's industrial. Electronics, semiconductors, solar panels. Electronics alone eat about 445 million ounces a year. Every solar panel, every chip, every EV needs silver. And that demand doesn't care what the Fed said on Tuesday. So let me say plainly where this leads. The thing that caused this week's drop, the Fed staying hawkish because inflation won't quit, is the exact condition that has central banks buying gold by the hundreds of tons. The crash and the bull case have the same root cause. Now, I'm not here to tell you to run out and buy. That's not my job. And this isn't financial advice. Here are the two honest scenarios, and you decide. Scenario 1. The Fed follows through, hikes in December, the dollar stays strong, and metals grind sideways or drift lower for a few more months. The paper market stays heavy. If that's you, a pullback is uncomfortable, but not the end of the story. Scenario 2. Inflation stays hot, the government's debt problem gets louder, and the central bank buying that's already happening accelerates. In that world, this dip looks, in hindsight, like a discount. The same way the people who bought quality assets during the scary headlines in past cycles did just fine. So what do you actually watch to know which way this breaks? That's the signal, and it's the open loop I promised you. Let's close it. Remember the buyer I opened with? The one that bought 244 tons while everyone else panicked? It's the central banks. And now you know why they're doing it. They're hedging against the dollar they're forced to hold. So here's exactly what I'm watching, and what I think you should watch too. Signal 1. The Fed's December meeting. If they actually hike, expect more short-term pain in the paper market, and more buying from the people who think in decades, not days. Watch the language as much as the decision. Signal 2. The next central bank buying numbers. If Q2 comes in at or above that 244-ton pace, the smart money is telling you it's still accumulating, regardless of the price on your screen. Signal 3. Silver's industrial floor. Watch solar and chip demand. As long as that's climbing, silver has a demand source that has nothing to do with fear and everything to do with the real economy. Look, here's what I really want you to take from this. The headline asks if the shimmer wore off. The wrong question. The right question is, when the most powerful financial institutions on earth are buying the exact thing retail is selling, which side of that trade do you want to be on? You don't have to answer today, but you should be asking it. Here's the bottom line. Gold and silver didn't crash because they failed. They dropped because the Fed got hawkish. And that same hawkishness, driven by inflation the Fed can't control, is exactly why central banks are buying gold faster than they have in years. The paper market panicked. The physical buyers went shopping. Before you go, if you've got savings you're trying to protect, don't just scroll to the next video. Grab the free inflation protection checklist I put together at timtalksfinance.com. 2 minutes and you'll know exactly where your money is exposed and where it isn't. That's it. No email wall, no sales call. Next video, I'm breaking down who actually holds that 39 trillion in US debt and what happens to those bondholders when inflation keeps running. It connects directly to everything we just covered, and one number in there genuinely surprised me. Subscribe so you don't miss it. I'll see you in the next one.